Is an adjustable rate mortgage right for you?
Could be. Here are 3 reasons why it might be the right choice.
But first, what is an adjustable rate mortgage? So a fixed rate mortgage, which is what people normally talk about, means it's fixed for the entire time. My interest rate is 6.5% and it will be that for 30 years. An adjustable rate mortgage is fixed for a period of time and then it adjusts with prime. So maybe you're fixed for 3 years or 5 years or even 7 years. And then from there it's a wild card. So it could be good,
go up,
could be bad,
could go down.
So how do you know if this is right for you?
So the first reason that it might be right for you is if you're just in the area for a short time. So maybe you're here for a residency or you're here to finish up a program or a shorter contract. And it doesn't matter what happens in 10 years because you'll already have moved on.
Touche. Another reason that it might be the right option for you is because you're looking to get a lower rate. And maybe you're a little bit more of a risk taker and you're like, I'm going to roll those dice. I don't care what happens on year 6. I'm going to fix it just for 5 years, knowing that rates might be a lot higher. In the 6th year, they could be lower. It's just a risk that you're willing to take.
And it can have some pretty big implications on what your monthly payment is. Now, none of these numbers are in factual terms. This is just an example that we ran. But say that you had a mortgage for $200,000.
Yeah, so I did the numbers at $200,000. So at 6.5%, for example, because that's around what a market rate is today, your payment for principal and interest would be around $1,260. On an adjustable rate, if you get 1.25% lower, it would be around $1,104.
Now, again, those are not like
I'm not
set in
offering
stone.
you
Yeah.
that, like right now.
It just could be. So, of course, talk to your loan officer to see if that's something that might make sense. And the third reason that an adjustable rate mortgage might be right for you is
if you are in a profession where your income is likely to change dramatically within that short amount of time. So maybe you are in a residency where you're a physician and your income will go up, or you're finishing an MBA or a graduate program, or just you're very upwardly mobile.
Or if you have a partner that's planning on going back to work because they're in school. So there's lots of reasons that could make this make sense to you. If you have additional questions, let us know.